Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Please kindly pay no attention to any special coloured highlighting on or for labels and text boxes on my daily chart. Sometimes my charting system plays silly buggers with my labelling and changes the colour for no reason. There is no special meaning into any coloured labelling. Anyway, the story of this market is a story of three channels. An original mid-June to early September shallow bear channel held up in late August at the important 38.2% absolute Fibonacci support below at 521, which ignited the bullish incentive enough to push up and out of the bear channel. The subsequently created early September to mid-October bull channel that peaked with a V-top formed in early to mid-October. The most recent example is a dark blue highlighted mid-September to early November bear channel, which I acknowledge may be morphing into a possible descending expanding wedge pattern. That's currently 526 to 576. Especially with prices forming an extension to the V-top over the end of October and the start of November. Now, three things to note. The September to October bull channel and the October to November bear channel come descending expanding wedge pattern together made the previously mentioned V-top pattern. The neck for such a pattern is approximately between the December 2020 low at 566 and the bright red neckline extension currently at 561 of the February to April reverse head and shoulders bottom. Last week the market broke down through the bright red neckline and tried to stabilize below it and the whole V-top. In doing so, the market reached the primary and secondary targets below for the breakdown from the original early September to mid-October bull channel. Although these targets were reached, the market did not stabilize under the bright red neckline and prices have since moved up to test the overhead medium moving average currently at 577 and the dark blue downtrend currently at 576 that makes up the upper trend line of the recent bear channel come descending wedge pattern. So far these have been tested but not breached or broken. Now, the overall move down last week brought up some new potentials, though not necessarily targets, down around the 38.2% absolute Fibonacci line at 521. However, below we have some interesting congestion at 545 and the September 2020 low at 540. And I will not hold my breath just yet as seeing these being tested. The final thing to note is that 2 Fridays ago, the combination of the declining short moving average, currently at 576, the flatlining short medium moving average, currently 593, and the very slowly declining long moving average, currently 590, all made a bow tie formation. Now, I am the first to say that is not a great bow tie formation, as the moving averages are in the wrong order and the short medium moving average is flatlining, not heading lower. But all that being said, it does look like a bow tie formation. Therefore, look to the immediate direction of the moving averages, principally lower, to show some guidance on the market. Plus, look out for volatility between 15 to 20 sessions after the crossover. So that's between the 29th of November to the 6th of December. Chicago corn. The gapping break higher in mid-September led to a small late September to early October bull channel that pushed up over both the gold long moving average, currently at 432, and the November 2020 high at 439, eventually peaking up in the 450 to 455 area in what appeared to be thin air, but in reality was a congestion seen from March to June, as well as back in January and February. Prices then dropped away through most of October, only as far as the green short medium moving average, currently at 431, in mid-October, before once again trying back up. This time the market was initially capped by the gold long moving average and conversely held up and helped up by the 50% absolute Fibonacci line at 425, such that 2 weeks ago prices pushed up over the gold long moving average and the November 2020 high at 439 in what was a small October to early November bull channel. That's currently 439 to 457. 2 weeks ago I said, and I quote, "The key question will be whether prices can attain the early October highs between 450 to 455, or will the erosion of the bullish incentive, for example, the gold long moving average or the November 2020 high of 439, whether this will be enough to prevent prices from trading higher. I doubt, as there is quite a bit of ammunition stacked up below between July and September. Further question is what pattern or patterns will emerge from the recent action." End of quote. Well, looking at the action over the last 2 weeks, you can see I was right in asking that question about the 450 to 455 area topside, but in error about the strength of the support below. It was a lot less than I imagined, and the effects of the erosion of what was then the overhead gold long moving average and November 2020 high were initially greater than I imagined, and we'd seen prices turn lower and drop down and close below both the very recent lower bull channel line and the gold long moving average. However, the market held at the rising green short medium moving average below and well over the 50% absolute Fibonacci line. Last week I fully expect to see further pressure on the downside and even the development of an early October to date bearish flag stroke halfway hesitation pattern. But nothing like this has happened. True, we are below the recent bull channel line, seemingly trailing along the underside of it, but we are still above the gold long moving average, which only had the single close below it, and well over the green short medium moving average and the 50% absolute Fibonacci line as well. To me, this means that the recent bull channel is not the dominant pattern here, and that another pattern is developing in the next few days, and I'll have to finesse this pattern or retire it completely. So it's all very interesting at the moment. Kansas City wheat. Much like Chicago wheat, this market is a story of three channels. The oldest and largest was the late June to very early September shallowly bearish channel that eventually ended up with a spiked down flattened V bottom at the end of August. Secondly, there is the late August to mid-October bull channel that was eroded by both the slowly declining long moving average, currently at 599, and the medium moving average, currently 581, as well as the interesting 38.2% Fibonacci line of the big old 2011-2019 move at 618. Finally, the most recent, the dark blue highlighted early October to date bear channel, currently 531 to 565, that looked good even between the last week of October and the first week of November, and that formed a small extension to the V-top pattern based interestingly on the bright red lower trendline extension, currently at 576, of the big old November 23 to April 24 descending triangle, and which looked good until this week. Well, going back a bit, the extension I spoke about was due to a pattern I spoke about 8 weeks ago when I said, and I quote, "During February through to April, we saw the development of a rectangle pattern based on the 551 to 590 area." Now, please remember this area as it became relevant to more recent action, and that's the end of the quote. This area was the origin of the original large bear channel, which I'd previously mentioned right at the start. Anyway, last week prices punched down through the bright red neckline and more importantly the congestion from the old rectangle pattern between 551 to 590, while still more or less staying within the dark blue October to date bear channel. This added further to what I said 2 weeks ago, and I quote, all this also still leaves two potential targets below. The primary target X at 531 and the secondary target, harder to reach target X1, down at 527. These are the targets of the break below the middle bull channel line, the late August to mid-October bull channel. End of quote. 2 weeks ago I was having some doubts about these, but last week I set those aside only for them to reappear this week as prices did not manage to stabilize below 551 to 590. The congestion from the rectangle pattern, instead moving higher up and out of the upper dark blue bear channel. Yet this week has not been one-sided, as the overhead bright red lower trend line the July 21 low at 578, and the moving averages have managed to cap the rise, and we are right now renegotiating the dark blue upper bear channel line once again, the market entering below it right now. So for the moment, those two targets below us, well, one target below, yeah, the two targets below are still in the frame, as I suppose is the 38.2% absolute Fibonacci line at 533 and the late August low at 527. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Service International Limited. And here comes the final important bit.